Hello students, in this video we will discuss what is capital structure and what are the factors which affect the capital structure. Now what is capital structure? Capital structure, it says the proportion of debt and equity used in financing the operations of business. The proportion, the quantity of debt and equity we are using in financing the operation business is called capital structure. So capital structure is allocation of debt and equity that a firm uses to fund its operation and expansion. Okay, so in simple words, if we say, so capital structure is how a firm finances its overall operation and growth by using different sources of fund. Okay, different sources like debt, preferred stock, equity capital, and any other sources, be it loans. Okay, so what is the proportion of different sources the company are using? Okay, so that is capital structure. Now let's have a look what are the factors which affect the capital structure. So these are the factors we'll discuss one by one. The first point is return on investment. Now what is return on investment? The investment that we do, we get some benefits from that investment, yes or no? So that benefit is, or the profit we get, is called return on investment. Okay, so if the return on investment is higher compared to rate of interest, the amount of return that we have to pay on interest is higher than the rate of interest on debt, that is on loan, then we must choose loan, that is debt. Okay, so that we have to give less amount of interest, so that less cash outflow is there. Okay, so if there is the return on investment is higher in compared to the rate of interest of debt, then the company must prefer debt in its capital structure. Whereas if the return on investment is less than the rate of interest, then the company should avoid debt and rely on equity capital. Is it clear? Next is cost of debt. So the company has various sources of finance. So if the cost of debt, okay, if the cost of debt is lower in comparison to equity, then the company should go for debt. Okay, if a firm can arrange borrowed fund at a low rate of interest, then it should prefer debt, otherwise it should go for equity capital. Next we have tax rate. Now if the tax rate is higher, then the company should go for debt, and if the tax rate is lower, then the company should go for equity. Why? Because when the tax rate is higher, the interest paid to debt security holders is subtracted from the income before calculating the tax. But when the company is paying dividend, company has to pay tax on that. Okay, so high tax rate means the company will prefer debt, whereas at low rate tax rate, the company will prefer equity in its capital structure. Clear? Next we have flotation cost. Now what is flotation cost? Flotation cost are the cost which are involved in issuing of shares and debentures. Okay, now in case the shares are issued, so it requires more formalities as well as more flotation cost. But in case of debt, less cost is involved because there are no such flotation cost in case of debt. So this point has to be considered before determining the capital structure. Next point is risk consideration. Up to what limit the company can bear the risk. Okay, there are various types of risks: business risks and then operating risks. Okay, if the firm's business risk is low, then it can raise money, capital, by issue of debt securities, but at time of high risk it should depend on equity. Next is flexibility. Now in an enterprise, the capital structure should be such that there is both contractions as well as relaxations in the plan. Okay, now debentures and loans can be refunded back at the time as the time requires, while equity capital cannot be refunded at any point, which provides rigidity to the plan. Okay, therefore in order to make the capital structure possible, the company should go for issue of debentures and other loans. Next point we have control. Now do the company want to dilute the control or not? What is their management policies? If the company's management policies are such that they want to retain the voting power in their hands, then the company's capital structure should include debenture holder. Okay, otherwise it should go for equity shares. Next is regulatory framework. This should be framework. Okay, by mistake I've written control. This should be framework. So regulatory framework. So issue of shares and debentures have to be done within the guidelines of SEBI. Okay, so and for taking the loans, the company has to follow certain regulations of the bank or the monetary policies. Okay, so if the guidelines issued by SEBI are easier than the monetary policies, then it should go for that equity shares, and otherwise it should go for debt. Okay,